Mike Wilson is CIO and Chief U.S. Equity Strategist at Morgan Stanley. And Mike, actually, this was something Dan Niles brought up last hour, too, vis-a-vis Apple, which has been lagging. You would think like a 10-ish% drop in the dollar during the quarter should help its results, but obviously AI is a bigger question mark.
Yeah, I think for the multinationals, there's no doubt that a weaker dollar, I think, is part of the story for why revision factors have continued to move even faster recovery than we had expected. It's actually as powerful as we saw coming out of COVID, which is hard to believe.
Wow.
And part of that is the tailwind from that weaker dollar. So there's a lot of tailwinds, Kelly. I mean, obviously the tariff situation is not resolved, it's nothing like it was 2-3 months ago. And the numbers did come down in anticipation of those tariffs, and so now it's almost a reflexive move from just the revisions having been so pessimistic, and now we have these other tailwinds. The dollar being one, I think less bad tariffs is the way I would kind of condition it, and then of course the other drivers that we're seeing now with AI picking up, the tax bill going through, et cetera.
Right. I mean, the strange thing about kind of the way the dollar plays into earnings and all of that is that we can all see it. We all know the level on every given day. It shouldn't be much of a surprise. You should be able to factor it into your models and all of that. And yet people seem surprised. We had a similar period last year where must have been a period of dollar weakness or something where it all of a sudden came, or maybe it's the opposite, dollar strength came up a lot in calls, and a lot of the stocks moved 4 or 5% on it. So obviously it's not fully priced in.
That's right. And I mean, at some point it does get fully priced in. And oh, by the way, we can't rule out that the dollar will have some strength at some point. In fact, technically, it looks like it may be making a bottom in the very short term. So yeah, it's an ever evolving situation. I think the one that doesn't get talked about much here more recently is just the precipitous fall in oil prices. And we know that oil prices now are down about 16 to 20% on a year-over-year basis, but gasoline prices are only down about 8 to 10%. So that's a new tailwind. I think they could offset some of the tariff risk for the consumer going into the third quarter, because quite frankly, the tariff risk is larger for the third quarter from an earnings standpoint, because this is where you'll see it start to hit the cost of goods sold, which they were able to avoid in Q1 and Q2 because they were selling cheaper inventory in those two quarters. So, but I think that weaker oil price is going to be a good offset for the consumer in that regard.
Mike, I want to get your perspective on Nvidia, not the company itself necessarily so much as what it represents when huge, well-known companies hit these milestones. I remember when Apple first hit $1 trillion in market cap, a lot of people were saying, oh, law of large numbers, what got them to $1 trillion won't get them to $2 trillion. They're going to have to come up with something beyond the iPhone that's just as big. They didn't. And also, very often, the leverage that these companies get, not in the debt sense, but in the operating power sense, over platforms, the sorts of M&A that they can do, products that they can create, might power them to the next level. So should investors be concerned about Nvidia or companies like it hitting this kind of milestone, the idea that maybe they've peaked?
Well, not in the short term. I mean, John, you're exactly right. I mean, the law of large numbers would argue that you can't grow as fast when you're bigger, and that rule holds, okay? But as we've seen in the last 10 years, these mega cap companies have kind of defied that logic. But there's good reason for it. I mean, many of these businesses are monopolies. They have great margin structures, and as they get bigger, to your point, they become even more powerful. So I think the biggest risk is not the law of large numbers, but can they kind of maintain these monopolistic type powers in their business models, and that remains to be seen. Some of them will, some of them won't. One thing we do know from cycle to cycle is not all of them make it to the next cycle, and I think that's the job of as an investor, is figuring out which ones can continue to grow at a pace that justify it, and which ones will inevitably not grow fast enough to justify these big market caps.
Mike, outside of lower rates, which I know a lot of people are wishing for, hoping for, maybe for Christmas, what's it going to take to get the smaller caps, SMID caps, also unstuck here?
Yeah, no, I mean, rates is the primary driver in our view. I mean, that has been our view. It's why we've remained underweight small caps for multiple years here, as the Fed was raising rates, and they haven't really cut as much as people were hoping. But it's not just that. It's also, think about this, right? So the president came in this year. They sort of kitchen sink the first quarter, kind of like a new CEO would. They're trying to liberate the private economy, shrink the government. Some of those things have worked. Some of those things are still a work in process. But I think that's the true story now for, I would say, the small caps and also the S&P 493 or the S&P equal weight. Can we get the private economy growing faster now and shrink the size of the government and remove this crowding out feature? I think that's the story for 2026. And AI productivity is going to be a big part of that. Can we get AI diffused into the broader economy? That to me is going to be probably the most important thing to get right, timing wise, and also does it actually work? Because that will actually electrify this smaller part of the S&P and also the average company that has really been underperforming now for several years.
Is that the gamble of the president and this Republican Congress's bill that they have passed into law, tax and spending, that this ignites a level of growth that makes all these concerns about the deficits and the impact on the bond market and all of that makes it go away?
That's part of it. It has to be, growth has to be part of the story for us to get out of this, debt burden that we've created over really 30 years, okay? It can't just be about reflating. It can't be about printing money. We have to get the private economy growing faster. We have to get productivity higher. There are solutions on the table. We see them kind of coming together. And look, nobody can forecast the future, but the fact that the market trades as well as it does, I think the stock market is telling us something about this. The stock market is kind of believing that the probability of that occurring is maybe greater than a lot of the skeptics have been saying.